So, Glenn, we've had a few people actually write in asking a few questions about obviously home loan topics, etc.
Great.
I'm going to have a look at some of these. Love to get your opinion.
Yep.
So, why don't I start with the first one here? So, someone's written in, can applying for other credit cards or loans hurt my chances of getting a mortgage? And how far back do banks actually look?
Yeah, sure. So this all comes under our credit report, that whenever anyone applies for credit, it gets noted on your credit report. So we've all got a credit score, and that's based on, these days in particular, it's based on your history. Any good or bad history is reported and you increase your score. Any activity such as applying for finance does impact your credit score and your credit report. In particular, the type of loan that you're applying for as well. So credit cards, payday loans, buy now, pay later facilities have a greater impact because they paint a bit of a picture as someone who's maybe a little bit cash flow poor or struggling. So that then puts a little bit of a dent on the credit report. If you're just applying for a home loan, that's not going to have as big an impact. I would say probably don't go shopping around for 3, 4, 5 different home loans because again, it paints a picture maybe of someone that's been declined and getting desperate and reapplying. So
awesome.
That's,
So the next question, Glenn, is your mortgage interest rate negotiable or is it locked in once the bank gives you an offer?
Yeah, so kind of probably depends on what type of loan we're going with. So I guess the two different types of loans are fixed and variable. Yes, your fixed one would probably be fixed or locked in. Again, there's a little variance on there or a caveat if you have a rate lock as well. So fixed rates at the moment aren't very, very common. So what I would do is probably just answer that question on a variable rate. Ultimately, variable rates change. So you would often be given a rate by the bank and that would be what your rate would be ongoing, I guess, initially.
It's pre-negotiated prior to the offer.
Correct, exactly right. You know, when we do all the work, when we submit an application, we've got you a deal and a rate that's as good as what it can be. Having said that, 3-6 months down the track, we can always look to negotiate a little bit further. Now, how far and how quickly banks will adjust rates depends, but yes, variable rates can be negotiated post-settlement.
Glenn, another question here is, can somebody still get denied for a mortgage even if they have a good job and steady income?
Yes, you can, is the short answer, because the credit criteria is based on a wide variety of factors. So certainly a credit job is one of them, income and capacity is another, but off the back of the income side of things, someone might have huge expenses. They might have multiple car loans, massive big credit card limits. Their living expenses might be beyond their means, in which case the bank would have a rough time giving them some finance. Other factors include credit reports. So if you've got defaults or arrears on an existing facility, a bank will have some issues in terms of giving you your credit. It might also be that you've moved around addresses in terms of short-term stability. So employment is good, income is good, but a lot of other factors come into play.
No, excellent. Glenn, what actually happens if you miss a mortgage payment? Is it a big deal right away or only if this actually happens more than once?
Great question, and something that we've gone through over the last few years in terms of having a lot of issues, you know, people financially throughout COVID and so on. So ideally we don't miss any repayments. Clearly that's in an ideal world. Sometimes things happen. Banks usually give you a little bit of a grace period, maybe a week or so, in case a direct debit bounces or there aren't enough funds in the account or something like that. Anything more than that, it clearly starts to get a little bit more serious. So on your credit report, the banks will note you down as a rating 1, which is not a good number. Any number is bad except for the number 0. And what it basically means is that you would then be up to 1 month arrears on your loan, or you've made it up to 1 month late. If you then got a rating 2, it means you're 2 months late and so on. So we don't want numbers on our credit report. We want to be making payments on time or close to it as possible and getting a rating 0 on the credit report. If that happens on multiple times, then obviously you're starting to have conversations with the bank. They're checking you out as to what's going on. And that can lead to, you know, obviously some nasty letters potentially and conversations.
Ooh, Glenn, I'm getting ready to buy my first home. What's the biggest mistake first home buyers make when applying for a mortgage?
Great question. I think probably these days, first home buyers maybe even underestimate their living expenses and they're looking to purchase the biggest home that they possibly can. I get a lot of first home buyers come to me and say, what's my borrowing capacity? and therefore that's clearly the maximum that they're looking for, and they then try and meet those obligations in purchasing for that particular value. So probably something to be really consistent with, and I guess have a good look at yourself, is what your living expenses are. What sort of lifestyle do you want to live once you get your property? What are expenses going to be? If you're currently living with mum and dad, you might not understand what gas, water, electricity, council rates, maintenance are going to cost you. So have a good conversation with mum and dad around what those sort of expenses are. Factor that into your budget and make sure you don't overcommit yourselves.
What are some last minute red flags that could make a bank pull your mortgage approval, like even after getting pre-approved?
It's generally pretty rare, to be honest, that a loan would get declined after it's been pre-approved, but it probably comes back to initially what type of pre-approval you've got. So it's really important that you get what's called a fully assessed pre-approval. Some of the banks are just issuing out pre-approvals based on data and electronic information that you've input to us as the broker, and we've passed that on. So there can always be sometimes errors in data. Maybe it's a misinterpretation around the income. Someone might be getting a bonus, someone might be getting overtime, and it could be construed differently. So that's one information. Don't get a system generated one. Always get a fully assessed pre-approval. From there, obviously a red flag could be spending your deposit, losing your job, maybe going into arrears or getting a default in between the pre-approval and purchase process. So it's really important that once you do have that pre-approval, obviously a great start, to then maintain consistency, stability. Don't go and spend all your savings. Make sure you can complete the transaction before you then go off into the formal approval.
That's great. Glenn, what is the best way to actually prepare for a market crash? Should I be moving money or just sitting tight?
Great question. Great question. And we had some concerns with people's finances a few years ago with COVID and income questions that were being raised, obviously, with the lockdowns and so on. And I think cash is king. Ultimately, if you can build yourself up a reserve, 3, 6, even 12 months worth of your living expenses, then that's going to help make things bulletproof for you. So keep those funds, depending on your structure. It might be in an offset account, but have cash reserves so that if something were to happen, then you're going to be able to ride your way through it.